listen-only mode, and there will be an opportunity for you to ask questions after the opening remarks are concluded. Should you need assistance during this conference call, please signal an operator by pressing star, then 0 on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Srinivasan Ravi, Chairman and Managing Director of Craftsman. Thank you, and over to you, Mr. Ravi.
Note on the market, it has been quite a challenging quarter in view of the elections, the summer, and it's been a mixed bag as far as the market is concerned. M&HCV has still not shown any respite. It's still on the declining trend. Whereas there has been green shoots and the tractor industry at the end of the first quarter. Two-wheeler has been very robust. Passenger vehicle has slowed down after a good 1-year growth period. The key commodity prices, something like aluminum, has increased quite a significant number. It is part of double digit. So strictly quarter on quarter or year on year, it's not comparable on the sales numbers. There has been a lot of optimism in the market now, and there is an expectation of private capex and growth going forward. So this we look forward to in the coming year. The consolidated financials, I just want to give the top line numbers. Turnover has been 1,151 crore. The breakup of that is powertrain 416, aluminum is 518, industrial engineering is 217. EBITDA has been 202 crore. And powertrain has contributed 107 crore. Aluminum products is 92. Industrial engineering is 14. Now it is more or less balanced, I would say, between powertrain and aluminum. And aluminum has been slightly growing faster. More of that later. EBIT has been 130 crore. EBIT has been lower compared to the previous year, 150 crore, because of increased depreciation, increased operation cost, and we would say that the Q1 of last year was a little robust. Q1 of this year has been a little weaker in the entire market situation. Standalone highlights, so the turnover has been 850 crore. The turnover has increased 756 crore, but our aluminum powertrain is 416 crore, aluminum is 242, and industrial engineering 203. EBITDA has been 152 crore, and EBIT has been 90 crore. There also we have done a lot of investments for the future, which is affected the increase in depreciation. Storage business has shown good growth, but I think the margins are still elusive. More of that in the Q&A session later. Capex for FY25 stands at 201 crore. We have putting up 2 plants, in one in Kodavadi and one in Bhiwadi, and I will make a separate note of that at the end of this statement. Acquisition, DR Axion, we acquired 100%, and now I would say the streamlining of the operations are still continuing, and we are now 15-16 months into the first investment, and we are on the right track. We have won a little more orders, additional orders within India, also for export requirement. So the operations are looking robust even going forward. Now a note on the strategic acquisitions which we have been planning. We have signed a definitive agreement to acquire a high technology foundry, the assets of a high technology foundry in Germany, in Frohnberg. And this has got marquee customers for the engine blocks for industrial engines. This is in line with our growth plan even within India, and this has got high technology, highly trained manpower, and that has been always in the forefront of casting technology. We have earmarked totally 120 crore. Out of that, around 60 crore for the acquisition plan, and another 60 crore to further put into investment for working capital, and this is an approximate number because considering the exchange rates which are prevailing at that particular time. So the breakup of that is the asset sale of the share purchase agreement, land and building is around 3.5 million euro, and around 2 million euro is for the assets and the liquid assets of the work in progress and inventory which is there. So overall it has been 5.5 million euro, and we have planned to invest another 60 crores into that over a period of time to make it more robust and try to make it a strong business which will also help us to build up our stronger base within India. The second acquisition target, still it is under work in progress. There is no definitive agreement signed. There is an MOU signed. Due diligence is close to be completed. So we will be in the coming weeks, we will be talking about that later. This is the aluminum business, which is also, it's not a profit-making business currently, but we are very hopeful, just like it's complementing our strength there, and plus it is giving overseas access to overseas markets. This company has got a history of 20 years exports to mainly North American market. Now I will also give a small update on the two greenfield facilities. That is, one is Kodavadi, which we announced in 30th October 2023. The phase one is in very good progress as we have been made, even though we estimated 30 to 60 months, 24 to 30 months for the implementation. I think within 12 months we will be able to complete the phase one. We'll be able to start some little trial production in Q4, and next year in the second half we will see a robust revenue coming in from that. This foundry will first cater to the wind sector for the windmill castings for gearbox housings and the critical planetary carrier housings and things like that. So this is initially targeted for the industrial engineering segment of our business. In phase two, we'll be targeting the heavy engines, which we are planning to make for industrial engines for the backup generators globally, which is the big, showing huge growth potential in view of the artificial intelligence data centers coming up all over the world. So this is on track. Now the second project, the greenfield project, which we announced in 27 January this year, that is 2024, and we have said 18 to 24 months, but I think we'll be able to complete the phase one project in 15 months, and we are likely to start trial production in Q4 of this year. So this will be fully available for next financial year. We are starting with structural parts of the two-wheeler, including the alloy wheel, and then moving to the IC engine parts, then to the passenger vehicle parts in stages. So initially we will put up the gravity die casting, and later on second phase we look at low pressure as well as high pressure castings. That will also depend on how much investment we go into that. It will depend on the second target which we have signed an MOU, how we are going to collaborate with that and tap the market. With this, I will leave the floor open for a Q&A.
Thank you. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and one on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and two. Participants are requested to use handsets while asking a question. We request all participants to ask a maximum of 2 questions at a time to allow all other participants to ask questions. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The next question is from Shagun Beria from Anand Rathi.
Hello, am I audible? Hello?
Yes, please.
Yes, thank you for this opportunity. I just wanted to ask, can you provide an update on both the acquisitions, Sunbeam and Fromberg, in terms of financials, likely cost of acquisitions and the opportunity from these acquisitions?
Yes, I had mentioned that the deal has been 5.5 million euro, and that is plus €500,000 of debt. So that will be totally a 6 million euro acquisition. In that, the breakup is 3.5 million is for the share purchase for the land and building, which is the asset of it, And the other fixed assets, including the movable assets like working capital, it is around 2 million is the question. So we can say that 60 crore is the acquisition, and we plan to invest another 60 crore over a period of say 15 months into the company.
Okay. And can you provide the margins have been weak this quarter, including the aluminum segment. What is really impacting the margins?
Aluminium, there is actually, as I mentioned, some market research shows that 15% the commodity price have gone up even quarter on quarter. Some say it is 12-13%. Let us take the lower number, 12-13%. So artificially the top line is inflated by 12-13%. That has maybe the EBITDA optically looks 1%, 1.2% lower. We are on track on the aluminum business, and Q1 always is a weak quarter for various reasons. One of the leading passenger vehicle manufacturers, they have a planned shutdown, annual shutdown during that period in middle of May, and there is always inventory correction. So we are on track on the aluminum. I think the growth number of 22% of aluminum in the standalone should be really looked at only as 14-15% growth. So when you look at that and then look at the margins, I think the margins are intact.
Okay. And can you please update on the capex and the investment guidance for FY25?
Capex approximately has been around 200 crore for the quarter, and it's ongoing. So we'll do it on basis of actual requirement of customer. We are negotiating with various customers. It looks very robust, and the export market is also opening up. But there is a question of chicken and egg story, whether we have the capacity to produce for the market or not. So we are taking some.
But how do you come to know that it's for corporate?
Sorry, somebody is on the line. Can you mute, please? Yes. So we will do the capex as and when required on this matter. I know you know very well that 2 plants are under construction now and under commissioning now. So that is how the capex looks. We see potential growth for next financial year to be much bigger. Then we may increase the capex. But now with this acquisition, we are looking at how to distribute the cash flow and acquisition plan targets, how to ramp it up. So it is a work in progress as of now.
Yes. The next question is from the line of Mukesh Saraf from Avendus Spark. Please go ahead.
I think maybe it's muted or.
Yes. Just give me a minute. I'll just check. Just give me a minute, management.
Yes, please.
Hello.
Yes, Mr. Mukesh, I can hear you. I think maybe you were muted. We don't hear anything.
Okay, sorry about that, sir. I hope now it's clear.
Yes, now we are able to hear you.
Yeah, so my first question is just looking at the various initiatives you have taken, in the sense you're doing 2 large capexes. You've just acquired DR Axion just about a year, and obviously now the German acquisition. So just trying to understand, I mean, is there too much that you're taking on right now? How is the bandwidth at the top management level to kind of execute all these projects? Obviously your business also is slightly cyclical, so we might encounter some kind of a weak cycle, say in commercial vehicles. So just trying to understand how are you looking at all of these actions that you're taking?
I'll answer the first part of DR Axion. DR Axion is now practically 17 months. It's been completed. I think it is not a capital intensive. We are not looking at capex there. It's only maintenance capex and a very marginal capex. And it is cash flow is excellent, and the management is intact. All the 8 Korean expatriates are continuing their job, and there has been no change. We are only supporting that activity in various forms. It has nothing to do with the day-to-day management of the company, nor any new customers. All 3 customers have been acquired by the company much earlier to our acquisition. So any customer we add will be now what is added is export to DR Axion Korea, which is added, and the other HMI's new plant in Pune region is coming up, where also business has been already awarded to DR Axion. Apart from that, these are the similar products already being made. So there is the technical team in place and doing it. So there's, as I mentioned, there is no capex and there is no increase in management strength which is required, and they are fully capable of handling it. Second thing is about the Kodavadi plant.
The two capexes, yeah.
Yes. The Kodavadi plant is a very strategic investment. Yes, there has been a new recruitment and there is also hitting our P&L for the even last 2 quarters, I would say. Yes, that is already factored in the cost run-up which is going to happen in the next few quarters. So there we are working in this industry indirectly for the last 20 years, and we are well on track for the timely start of production and first time right approval of these products. And we have engaged multinational consulting firms, Germany, to support us on this activity. And for what we hear from our customers, that we are on track to break this barrier about the cast iron foundry. Coming to the facility at Bhiwadi, this is the processes what we follow in Craftsman and DR Axion for gravity die casting. The parts what we do are equally complex and in certain cases more complex also. We look at the cylinder heads and cylinder blocks, and now we are looking at other structural parts like alloy wheel and other structural parts of the two-wheeler going ahead. So these type of alloy, we have been managing these heat treatment or the composition of these alloys and how to melt, how to the process parameters, how to control them for the last 22 years in Craftsman, and DR Axion also in India is almost 18 years old now totally. So this expertise is already available with us. It's only the product is slightly different, and the product is of high volume, and we don't see a challenge. And we, to put the frank, we are using the synergy of Craftsman as well as DR Axion for setting up the facility at Bhiwadi. Right. So we have not put up high pressure die casting nor low pressure die casting at Bhiwadi to start with, unless we are successful on the phase 1 of the project, which we are very close to cracking that. So once we do that, then we'll engage on that. We take a step-by-step approach on this matter.
Right. And then you obviously have Sunbeam and the German acquisition as well in the cards.
The German acquisition has been running. This has been self-contained foundry for a long time. So we don't intend to meddle with the management or interfere with the management. There, it was part of a bigger VNOT group, and the VNOT group had not been paying attention to this particular foundry because they had larger foundries in their fold, and they had acquired new foundries which they lost some money, and that is the reason I think they were insolvent, which is on anyway public domain. I'm not supposed to talk too much about that. There's a lot of this news of VNOT is on the public domain in the newspapers itself, in German newspapers. So this is an asset which is been producing and continuously satisfying the customer. We were in touch with the customers, and some of the customers are also asked us to acquire this with the promise of continuing the business, and they have participated in the meetings also, and this is I think the great way to go with. And this size of the acquisition, as I mentioned, it is the outflow is 5.5 million, including $500,000 debt what we are acquiring there. So it is 6 million. So the 60 crore acquisition, that is it. So we have planned as some backup for further working capital and minor capex, just to be factored in what is needed for next 18 to 24 months, and just factored in another 60 crore to look at it. This foundry has been, most of its history, if you look at the last decade, it has been a bit positive, except for a few years, maybe during the Lehman crisis and during the COVID and things like that. Otherwise, this has been always positive, and the customers are very, very supportive for this, because most of the products what they make supply is single source. And this is and when we are buying an insolvent company, it doesn't come with the baggage of old liability of the worker liability. Of course, the worker agreements survive, but we are not saddled with the past liability of the pension and things like that, which is part of the insurance which has been already paid off because we are buying the asset from the insolvency administration totally. So that way it is coming as a clean. We are not taking over the foundry as a company. We are buying the liquid assets of the foundry, that is the movable and immovable assets of the foundry, and the land and building we are doing a share purchase agreement which is part of an Fraunhofer Immobilien, which is a separate company which is only doing the real estate. So really speaking, we are not acquiring any past liabilities there. And as we visited the foundry, it is running well, doing well. Even in the first 6 months, they have declared a very good positive EBIT on this, and we are confident about that. Coming to Sunbeam, I will be restricted to answer. If I completed the answer on Fraunberg, I will limit my discussion on Sunbeam because it's still an MOU. It's not a different agreement.
Right. So the question actually, sir, I get your point on all these things you mentioned. Just understanding, in terms of managing all of these two, at the same time, are you looking at certain top level, additions to your team? Are you looking at any of these things? Because to actually turn around or run these foundries, you will need expertise to bring in your processes in place in those plants.
The Fraunhofer facility, whoever is sitting in the Fraunhofer facility and managing, 100% of the people we are taking in our roles. That is, including the two main people who are employed by the head office and placed there. That is, including them, it is 140 or 141 people. So it is self-sustained system. We only need to put somebody for IT, which they themselves will recruit and put it, because that was in centralized system. Apart from the IT and accounts which was centralized, everything was a self-contained ecosystem which is running even today under insolvency administration for the last few months. Seamlessly it has been running. So we don't require administration there. We need a strategic direction of what to go and how to go and which direction to take it, and how we can also support each other. There's the Indian operations and their operations supporting only. So we are not going to put any management in Europe. We are not going to recruit any management in Europe. We may depute somebody here on a visit basis, not even permanently putting up there.
Got it, sir. Got it. Thank you for that detailed answer. Just one last bit. On your powertrain segment, in the standalone business, could you just give the breakups between CVs, tractors, and off-highway?
Okay, before that, I will just touch on Sunbeam in general. Sunbeam is coming with a lot of experienced people, a lot of experienced management, a good marketing team and good developmental team, which will actually not only help Sunbeam, it will also help Craftsman to acquire new businesses. So actually it's strengthening Craftsman aluminum division when to do it. There is no need for Craftsman to add any top level management for aluminum, because there is enough capacity in Sunbeam's administration, and we have excellent people there.
Sure. Got that, sir. Got that.
On the powertrain, the breakup is top line is 54% on the commercial vehicle breakup, off-highway 16%, and tractors 14%, and in the passenger segment mainly SUV 16%. So passenger vehicle has seen growth, and all other things have stagnated or degrown.
Sure, sir. Sure. Thank you so much. I'll get back on the queue.
Okay.
The next question is from the line of Dev Agarwal from FECOM Family Office. Please go ahead.
Hi, sir. Am I audible?
Yes, please.
Yeah. Thanks for the opportunity, sir. So, in the annual report of 2024, FY24, you have mentioned that the aluminium usage in India is around 40 to 50 kg, whereas in other countries it's around 150 to 180 kg. So, what is it like? Why is it in India that we are using so much less aluminium in the commercial vehicles or any other vehicles? And if we want to increase the usage of aluminium in products, so what other products would be there in which we can use the aluminium usage? So that's my first question, sir.
I think the question is more pertinent to passenger vehicles because it's not commercial vehicles. That is the benchmark we have taken, I think, in the annual report. I think the aluminum content in Europe as well as in North America has started to increase more than 1.5 decades ago. And now in India, when new platforms are getting introduced, we are seeing more and more aluminum content because earlier the platforms which were there, which are a few generations old, they had less aluminum content. Only the engines and the transmission area and the powertrain area was tweaked, and the other body and other interiors were tweaked, and new models were coming out. Now everybody is going for new platforms in the near future. We'll see aluminum content surely growing there. Also in Europe, it surely will always be higher because they are high performance passenger vehicles. The average engine power and capacities are much higher. They travel at much higher speeds in Europe. So we will not strictly comparable, but I think the gap will still continue, but we are at a very low level, and surely aluminum content per vehicle on the passenger vehicle passenger car will surely increase. Aluminum, we are at quite a decent level on the two-wheeler segment on the aluminum. There, the one trend we see, all the spokes and hubs have gone, which were earlier in steel. Mostly it is gone. Now it is all alloy wheel. Earlier alloy wheel was a premium, whether it's a passenger vehicle or even a two-wheeler. Now it is almost everything is coming in the alloy wheel. That is also part of the aluminum content. But the other structural parts of the passenger car, including shock towers or knuckles and all things, it will take some more time to become US aluminum. But I would say aluminum is a growing segment in general.
Okay, sir. And my second question would be on our capacity regarding the aluminum casting. So what is our total, capacity in aluminum casting as a whole?
See, I've been saying this at least in almost every call. Aluminum, unfortunately, even after their acquisition as Craftsman Group on a consolidated basis, we are subscale. We are not able to even attract any multinational customer to look at us because the number which we are talking about today is very, very small. Our consolidated number is hardly 2,300, 2,400, 2,100 crore, whereas the global companies are anywhere between, say, 10,000 to 20,000 crores in that region. So we are talking about China Plus One, we are talking about growth opportunity, we are talking about export opportunity, but unfortunately, sadly, we do not have the capacity to fill it. So this is the reason of our little, I will not say aggressive, but I will say strategic steps which we are taking, that we are not trying to build up everything on the greenfield, because the greenfield, to acquire a customer, to develop a product, to get it approved and then ramp up the production, it takes 5 years, and there is a huge drain on the investment which is done because of the startup cost and pre-operative cost, and not only that, the losses incurred in the first 2-3 years of operations. So we are doing acquisitions where we can turn it around quickly. That we have already proved out one. The second one still is in a MOU stage, but we are confident that we can work with the management, which is very excellent management, the technical management I mean, and also the administration is also good. So we can leverage that. The global clients are there for you to see on their website, because as signing an MOU, we are not able to talk too much about it today. So that far we are clear, and our own strategic initiative on aluminum, we have taken the volume runners from the structural parts, which so far we are not present. EV or no, not EV, these structural parts will remain on the two-wheeler business, and future we are also going into structural parts of the passenger vehicle. So that way we are having a balanced aluminum portfolio. Before we acquired DR Axion, if we remember right, our dependency on two-wheeler market was close to 70%. And then even though we added Stellantis as a customer, Stellantis is ramping up in this financial year after a 2-year delay, and we are seeing good growth traction in the next year. Even then, Craftsman is still dependent on two-wheeler to a great extent. But after DR Axion acquisition, now the passenger vehicle segment on the consolidated basis is much, much higher than the two-wheeler business. Now there is an export which is hardly 10%, even on a consolidated basis, not even 10%, 5 to 10% on the aluminum segment of the business currently. With possibly Sunbeam, I think Sunbeam has got a good exposure to export, is almost 15-20% direct export, and the orders which we acquired also is, which I cannot openly talk about it because we are in the due diligence stage. So it is showing a lot of promise going forward. So the global market is already available. So this means that we'll be spread not only within India on the passenger and two-wheeler business, but also for the passenger vehicles outside India.
Sorry to interrupt, sir, but I did not get your number of units. I mean, the capacity you said, I was not able to hear. Can you repeat that, sir?
Sir, capacity, you're talking about tons or something, because it is misleading, as I mentioned. Because if we are talking about tons, we can sell 1 ton at 2 lakhs, we can sell 1 ton at 3 lakhs, we can sell 1 ton at 4 lakhs. So this is a little misleading number, because the structural parts, simpler parts are at some pricing. There are very, very simple parts on ADC 12 aluminium, which aluminium price itself is lower, and the tonnage. So overall, when you look at the tonnage currently, we are having, it is close to around 60-70,000 tons, depending on product mix. We are at that range currently. So if that is giving you an answer for the 2,000 and 2,200 crore turnover, currently you can understand that the simpler two-wheeler parts like the covers, they are only 2 lakhs per ton. Whereas if you look at the higher commodity, the passenger vehicles, cylinder heads and all, they are more than 3 lakh a ton. So it will not be apple to apple, I would say.
Okay, sir. Thanks a lot.
Just a reminder that all participants should have a maximum of 2 questions. The next question is from the line of Sandil Kumar from Joinder Capital Service Limited. Please go ahead. We move to the next question from Varma Danish from Varma Associates. Please go ahead.
Yeah. Hello. Thank you for the amazing presentation. My question is on the Sunbeam transaction. I understand that we have signed the MOU and it's still in initial stages. But as per the MOU, it says that we have excluded Gurgaon. But the credit reports I have read, it says that it houses a lot of export business. Is this outside the scope of the transaction?
The scope of the transaction is the entire business. So in the MOU, because of there is a labor issue which is going on and the land is little prime land, so decision has not been taken how to handle all that. I think the current management is working out all that, and we are not exactly participating in that situation because we are an outsider. So we didn't want to take any past associated risks which are there. But the business by itself, the Gurgaon plant, most of the business has been transferred to other. I think 40% of Gurgaon is there. Today, as we speak, in the entire revenue stream, it's only 15 to 20%. But you're right about revenue streams are coming from there.
Yeah, it's better now?
It is better now.
Yeah. Sure. So, firstly on Sunbeam, so we are acquiring an asset which is quite stretched over the last 5 years. We look at the numbers after the Kedara acquisition, they have been making huge losses, and debt on books is also quite high. So just wanted to understand what your rationale behind this is. Obviously, I know the customer profile and all is there, but besides there anything that you're missing out on? And what is the kind of projection that we have done in terms of the turnaround we can do in this company? And secondly is on the acquisitions post this. So once you are done with Sunbeam, how many acquisitions can we expect more from this QIP money, and in which segment / geography can we expect? Yeah, that's all.
Okay. You're right about your assessment of Sunbeam. FY24 numbers are not finalized or not in public domain. FY23 numbers are there. It is for everybody to see there what is really happening. Top line has been around 1,200, in the range of 1,200. I think you can see also in the FY22 or FY23 number, whichever has been published, you can see a high manpower cost which is there, which is not proportional to the turnover of 1,200 crores totally. So you can also understand that they have been trying to shift the plant, and they created one more plant in that aspect. So there has been shifting costs, there have been duplicate investments which are there. So definitely it has been stretched. So I want to put it a matter of fact very, very clearly, we are not taking over any debt of the company. That is clear on this matter. So that is 100% very clear on from day one on this matter. So whatever is the finalization which is going to happen, it will be for the business and the assets somewhat on the team of Kronberg, but whether we are taking over the assets or we are taking over the company, only time will tell. So I don't want to comment on that. But we are not really paying for the company or taking over the debt is what you need to bear in mind. So I think beyond that I will not be able to say anything because still it is, and we are very, very prudent to use the money of the company. You see how we have used DR action, and certainly you also seen the German acquisition is the acquisition cost is only 60 crore, but we are putting in another 60 crore as a precautionary method for the future requirements, and we are sure that it's already a bit positive. So we are sure about the returns and return of capital. So we are very careful about using the money. The third point about how many more acquisitions, yes, so this acquisition of DR Action has been aluminum. Sunbeam is ongoing. I think it's finalized yet. It is again on aluminum. The Kronberg is on the powertrain portion of the business. And we will be looking at further within India only, not outside India, for possibly industrial engineering and also powertrain, which is a composite, or it may be a composite unit also. We will be looking at that particular portion. Everything depends on our financial matrix, how we are able to take it up. And as one question had come from Mr. Mukesh, that our bandwidth to manage, we always consolidate on whatever we take over, and once we are sure about it, then only we move to the next step. There is a lot of dialogue happening for the last 2-3 years on M&A, which we cannot disclose. But whatever works for us and whatever we are capable of managing and turning it around, we will touch upon it.
Okay. Thank you and all the best.
Thank you.
The next question is from the line of Vinay Nadkarni from Hathway Investments Private Limited. Please go ahead.
Yes, that's one question from Ken. Am I audible?
Yes, sir.
Yeah, that's one question. On the German acquisition, what is the revenue expected and when will it flow in, and what kind of EBITDA are we looking at?
I would say that the past 3 years of revenue, which is calendar year 24 is not published yet, but I know an approximate number. But the whatever 21, 22, and 23 we already put on the our website. It's already been put. Calendar year 21 was 23 million euro. So we will just take a number of 100 rupees. So to convert it was 232 crores in 21 calendar year. 22 was 255 crores, and calendar year 23 was 257, and calendar year 24, as I understand from the management, it is around the similar number. So it's around 250 crore is the top line, and they have been having high single-digit EBITDA.
Okay, thanks a lot. That's all I had.
The next question is from the line of Sendil Kumar from Joinder Capital Services Limited. Please go ahead, sir.
I think, please unmute. I request you to please unmute.
Yeah, is it audible now?
Yes, now.
Yeah, I have two questions. First one is, this quarter we have repaid around of 900 crores of debt, right? So how much we can save in terms of interest costs in the forthcoming quarters, sir, of FY25?
So the stated objective, whatever you've done is very clear. The debt reduction is, one is 250 crore was for the acquisition of DR Axion, is very clear in the stated proceeds. And 20% was for general corporate, which is around 400 crore. 300 crores. So only 650 crore was going to debt reduction.
So what will be the gross debt at the end of FY25?
So I will not be able to comment on that because whether Sunbeam goes through or doesn't go through, and how the capex, how we are seeing FY26 to unfold. The real China plus one unfolds, we want to be ready. The China one plus one doesn't unfold, we should not be overexposed is the stand what we are taking. There is a lot of rationale behind what we are doing, of detailed study about all the manufacturing countries in North America as well as in Europe. And we see a tipping point that the winds may blow in India direction, provided the suppliers are ready to deliver the global requirements. So that our investments will depend on the customer confidence and the orders for which we are going to get in the future.
And my second question is, actually last few quarters I could see that powertrain business, we are reporting a negative growth on EBIT level, EBIT level on year-on-year basis. So when can we expect a positive growth on this business particularly?
There are two tailwinds which has to happen. One tailwind is, of course, the commercial vehicle pickup, which is in common public domain. Everybody knows that the customers, what they're doing, and what is the commercial vehicle sales, how it has been behaving post FY19. And little it had some uptrend post-COVID, and after that it is subdued, but I think it's all related to the GDP growth of the country. Surely there is a replacement market. I don't see that this trend can continue, negative trend on the commercial vehicle, it can continue for long. Maybe for a year more, and then afterwards it should pick up. Tractor has already seen some comeback to a decent level, what we are seeing in the month of this particular month of July. And the tractor manufacturers seem to be upbeat for the coming year. So both are related to the powertrain. On the passenger vehicle segment, we are doing decently well already, and there is nothing which will improve from that particular point. Yes, we have got some more business on the passenger vehicle segment on the powertrain, which will have some financial result coming from next financial year. This is the total headline, but I want to now highlight that last 3 years we have been working on one particular segment, the industrial engine segment. First, we have set up a machine shop for that. The machine shop is mostly ready. In the last 2-3 years, we have diligently invested. Now, for the foundry, we have not gone for the engine blocks. We have gone for a general purpose industrial foundry because there is a lot of development cycle time is 2-3 years for a large engine block paying 10 tons or 6 tons. Because engine block will cost anywhere 10 lakhs, 20 lakhs per part totally. Mm-hmm. It is not about a simple part. And the development cost is running into 20 crores, something like this, which customer has to bear, even more, including the testing. So the gestation period being very, very long, we have been very careful about committing, but I can confidently say one thing, that we are very, very secure for future growth in the powertrain, in the industrial engine segment. That is when we are very confident, we renamed the auto powertrain division to powertrain division totally. And all our customers are in the range of maybe 40 billion, 60 billion sort of revenue customers, which are only making engines, I would say, totally, or mostly 80% of the revenue are coming from engine and powertrain related activity. And this is the tip of the iceberg, and this the forging companies have been very, very good at exploiting this for decades together. But on the cast iron foundry segment, nobody was able to do this activity, nor the machining capability for this high level of machining was there. So we are entering into a new segment of the market which have very high growth potential. So When will the potential happen? It will happen from FY27 onwards, FY26. From Q4 onwards, it will start seeing. But after that, we will see, I think, many years of good growth on the powertrain, regardless of the commercial vehicle business. But we also see headwinds in Europe and US for Tier 1 companies, which more and more outsourcing is coming to India. That is also will be another tailwind. So powertrain by itself, it is a lull now, but the long-term prospects are very, very strong. And I want to answer one previous question about aluminium from, I think around 10 minutes back on per ton basis. See, I think we are not valuing whether the powertrain business per ton nor aluminium and power ton. So aluminium has also got very, very critical machining. Now what we are targeting for exports is not only aluminium casting by itself, it's the machining strength also which will portray in that. So calculating capacity by tonnage will not be the right thing on this matter. And we have proved over a period of many, many years that on high-end machining we have proved very well both on the powertrain as well as on the aluminium.
That is very helpful, sir. Thank you. That's it from my side.
The next question is from the line of Joseph George from IIFL. Please go ahead, sir.
Thank you. I just have one question that's in relation to the German acquisition. So, you'll be investing, say, approximately 120 crores, and if I look at the current revenue run rate of about 25 million euros, for next year it'll add maybe 3 or 4% to your consolidated revenues. Now, when I think about it, for 3 or 4% addition to revenue, you're going to a completely new geography. 120 crores is not a big number, but a completely new geography, new challenges, etc. So I wanted to understand what really is the grand plan behind all of this. I'm sure you're not, making this acquisition for 3 or 4% addition to revenue. So is it that, the 25 million revenue can go up 2x, 3x based on the current capacity that they have? Or is it that you can use that technology to, maybe introduce new products in India for Indian customers, or whether you can get orders from European or American customers for manufacturing these products at a